Welcome to the MHP Exchange, where the riches are in the niches. We'll show you how to invest your way into mobile home parks with real strategies, tips, and behind-the-scenes know-how to grow your cash flow. Stick around. This is where smart investing begins.
Today's guest on the MHP Exchange needs no introduction. It's Glenn Esterson, the MHP expert. And that's just not a self-proclaimed title. That is earned with over 20 years experience in the mobile home park industry. And was literally one of the first national brokers to specialize in mobile home parks. He's an accomplished author. He's done, hundreds of transactions in 40 different states across mobile home parks, RV parks, and he's really seen the evolution of the industry firsthand. I've known Glenn personally for over 10 years, or just about 10 years. We've done a couple of deals together years ago, so we've been in the trenches. I know his knowledge base, and we're really excited to have him on to talk about what's happening in the mobile home park industry today, where he sees the market headed going forward, and kind of lessons learned along the way. So if you're out there listening today, you want to learn about mobile home park investing, or you're an experienced investor in this space, this is an episode you're going to want to listen to. And with that, Glenn, welcome to the program. Thanks for being on today.
Thank you, Frank. Happy to be here, my man. Happy to be here. And it's always good to see you. It's always good to see you.
It's always good to see you as well, my friend. I know it's been a while since we talked last, but for those of us for those out there that might not be familiar with the name, which is hard to do if you're looking for deals in this space because you and your team cover a wide breadth of it. But you've been in this space for 20 years. What was that?
Plus,
how did you first get involved, and then what made you stay?
Oh boy. Yeah. So I don't know, 20, 25, 30 years ago or so, I used to be a farmer, and I used to grow mushrooms of all the things in the world to grow. Right. And I was living on a farm in the middle of nowhere, North Carolina, and had almost no money, but just enough money to go buy a trailer park. And we definitely used to call them trailer parks, back in the day. And so I had gotten licensed a few years before that to try and, flip a house or do whatever, sell a little apartment building when I was able to. But, it wasn't something that was very predominant in my life. Farming was like my passion. And I grew up, I've been farming since I was like 16 years old and all the way through most of my 30s. And a realtor guy called me and said, "Hey, you should come check out this trailer park. It's like, 30 miles, 20 miles from where I was living." And where I was living was far from anywhere. It's, 30 miles north of Asheville, middle of nowhere. Nearest gas station was probably 15 miles away or so, so it was, very remote. And he drove me out to this park in a town called Irwin, Tennessee, and introduced me to the seller. It's a cute little park, 40 something spaces. And the guy was willing to finance it for me. And so I said, "Oh, okay. I don't know anything about this industry, but I'll, at first I turned it down. 6 months later, it was still available. He gave me a better price. I said, "Okay, fine. I'll take the literal last of my dollars and go and buy this thing and help me supplement my income on the farm." And for a year or two, it was real well. It went real well. It was nice returns. And I started learning the industry that way. It was nothing like what I had expected and nothing like what I had learned about, houses and apartments, and the tenants were bananas. And eventually, in the beginning, I made some money, but then the owner finance that he gave me was only like 1 or 2 years or something. And so eventually I had to go find a loan for this thing. And that was challenging. And I went through a whole learning curve on that. And, so I bought this thing. It was, I don't know, maybe 04, 05, somewhere around there. And about 2-3 years into it, the tenant base started decaying significantly. They started getting hooked on drugs, and a couple of bad tenants moved in and just started destroying my life. And then 2007, 2008 happened, and everything really started to crumble. And I had like a 5-year bank loan that was like coming due, I think in 2010 or something like that. So I was like up against that kind of, maybe it was 2011, up against, some guns there. And really went through the ringer on that one. Somehow pulled it off by the end of the day, and said, you know what am I doing? Like, let me turn this thing. Let me sell all these homes. One of the some guy that was like focused on mobile home parks as a career. Came out and met with me in my park, and I was like, please sell my park. He's like, not a chance. I won't touch this thing with a 10-foot pole, but I'll tell you what to do to get out of this thing. And he kind of explained, his model to me, told me to sell off all these homes, even if I had to give them away for free and turn these guys into lot renters. And then put this thing out on the internet, Craigslist, things like that, and offer seller financing. And, after a few years, I finally really got the handle of it, cleaned the park up, connected to city sewer, kicked out all the crackheads, and got the park back to looking good, running well, and did exactly what he said. Eventually sold it on a note. Before I got sold it on a note, though, I got back, I decided to leave the farm and start, brokering. And I said, there's not much that I know about, but I hate trailer parks and never want to see a trailer park again. Never want to touch these things ever again. And, I realized, that, unfortunate for me or fortunate for me, however you want to look at it, that was my calling. It was like trailer parks is what I'm stuck in here now, in 2025, I'm still touching these trailer parks, and it's like my whole life, my whole investment life, my whole life is around these trailer parks now. Farming is not what I do anymore. And definitely it's been a very interesting ride. And that small little park, which, almost bankrupted me, but also kept me afloat at other times, was really a turning point in my life, from going from from one kind of lifestyle, living on a farm, and, literally growing all we ate and, doing that whole thing to where I am now, living, I live in Wilmington, North Carolina, and I still own the farm, and, but now all I do, every day is trailer parks. And I know I'm not supposed to call them that anymore. They're mobile home communities or land lease communities or whatever vernacular we're using for the era that we're in. But in my brain and the way that I still kind of envision these things, they're an interesting asset. So since then, I've developed the MHP Expert. I've written a book. I've led one of the largest teams in this industry. I'm a seed investor in Rent Butter, which is hands down one of the best tenant screening applications out there, and we've done extremely well with Rent Butter. And I was just lucky to be involved in the seed round. Good friends with a lot of those guys. I'm founder of the MHP Accountant, which has done very well over the last couple of years. And that helps guys with their cost sags. It helps guys really understanding their bottom lines and getting their GLs in line, so when they go to ready for sale, that their books are clean and orderly, and we can sell them to the next guy on a better basis for the seller. And we have some infill companies that we do. We're doing some infill here in Southeast North Carolina. I'm an LP or a GP, and I don't know how many thousands of units. And the one thing what I learned through my whole lesson was operating a park was not for me. That was the part for me that was like the learning curve was too painful. I was too nice of a guy. Every person's, my parks, their mother had cancer, I don't know, 800 times. Everybody seemed to not be able to pay their rent, even though they had a stack of beer cases, empty beer cans all over the porch. And my lot rents were $75 to $100 back then. And,
wow.
Yeah. And these, my trailers are renting for $250,
Wow.
And, yeah. And so it was like baffling to me how these guys couldn't afford the rent, how they had all these problems, and how I was under a trailer, 10, 12 hours a day, fixing piping and fixing septics. And like, that side wasn't for me. What was for me was helping people learn how to avoid doing that.
And that's an interesting point, because I do come from this space as a broker myself, and my focus had always been on the investment side, but I would also be looking proprietarily myself. And how do you think that kind of helps set you apart, especially in an industry where there's so much that you have to learn? I mean, everybody thinks it's, hey, I buy a park, it's super passive. They own the home, they own the land. Great. It's hands off. But I mean, it's more than that, right? Or would you agree that that's
yeah. Yeah, I mean, like for me, what I tell people is like, no matter what you heard, it's wrong. Okay, like you're gonna walk into this thing and it's gonna be a nightmare. I set the expectations so low, I punch so hard to the gut that I try to scare them off to get them in, because I do not want them coming back to me after a first purchase telling me that I screwed them, telling me that I didn't set their expectations right, telling me that they didn't know what to expect, and I told them it was going to be all fluffy and la la, and here they are going through the struggle that I was going through. And that was, for me, an important way to kind of help people understand what they're going in, which again, this is why I wrote this book back here. And I don't hold any punches in that book. I mean, it's like, this is not an easy business. Now, there are plenty of deals out there.
I just want to say that for people who don't know the book, right? It's the Mobile Home Park Manifesto, correct?
Mm-hmm. Correct.
And then they can get that on Amazon, because I know it was an Amazon bestseller, right?
Mm-hmm.
Okay.
Yeah.
So go on. So
it's on the website too for like half the price, but it's a digital thing. I can't print books. Sorry, it's an Amazon job, but you can get the digital one on the website if you want it. If you don't like it, just send it back to me. I'll happily. You don't even have to send it back. Just tell me. I'll give you your money back. But it's sold now. I don't know, tens of thousands of copies. I think we're over 30,000 copies now or something. It's done very, very well for our small little industry. And it's what I really tell people is like, it's not coupon money. It's not this coupon clipping passive income thing. Not unless you're the GP the LP in the deal. Then it's fairly passive, but your returns aren't going to be as good as the operators if he ever gets a good return on it. But if you're an operator of this park, it's probably going to be one of the hardest learning curves you went through for any of the investments that you've gone through. The infrastructure alone could capsize your whole business, especially if you're just looking at the yield that, some of these parks pretend to show you on paper. It could really, not go as planned, and so we really try to help you understand that, so our MHP expert company is more of an advisory kind of grassroots kind of thing. We help you. Our Esterson team will sell you and sell for you. And then our other companies help support it, Rent Butter and MHP Accountant. We try and give you a full comprehensive kind of like way to kind of be safe. And then like some of the offsite managers that third-party management groups that, that we parlay with sometimes, they're also very good. And so, you can get a turnkey system, but your profit's just eroding at this point. So a lot of these guys that buy these parks, they hear 10 caps and they hear 20% IRRs and they hear, if I buy this park for $1 million, I can turn it into $5 million in 4 years or something like that. Yeah, okay, you can sometimes, it's a thing. I've helped people do it. Most guys don't get to do that. I certainly didn't get to do that on my park, And, like the parks that I invest in, that if that's the deal that's being sold to them, I'm telling them to walk from it, because that's insane. You're probably buying the turd at the end of the day, And so for me, I talk a lot about, basically, time value and headache, sort of like a balance beam, and at my level where I'm at today, the headache is more important than the value that I'm earning. It's more, and the time that's going into something versus the headache that I'm dealing with. I don't want that massive value add anymore. It could be a little too challenging for a lot of the guys out there. When I was young and just full of angst, fine, give me that hard thing. I'll go bite on that all day, but the older you get, the more you realize there's easier money out there. That 6 cap that's stable today is probably going to make you plenty of money over that same period of time that you're going to be able to grow realistically without all the brain damage, especially if you're, the operator, the, non-syndication type of guy. Now, if you're running a fund or, if you're raising money and you're trying to tell these people you'll get them all this, all this meat on the bone and you're selling these 20 to 25% IRRs, okay, fine. You're going to have to go bite off something insane. But you're going to be working for it. You better have a heck of a good management team lined up and a good maintenance team lined up and a whole bunch of good systems lined up, because you're going to be working for it. Yeah, I've seen what you've gone through at some of the parks that you used to buy. It's like and now what you're buying today. Some are sometimes pretty tough deals, but now you got the whole system in place. It makes it a lot easier for you. But I remember back in the day, I sold you a park. It was a doozy. It was a doozy for you to get your hands around,
100%. And it's about having the right team. I think you nailed it. It's having the right team. It's having the logistics in place, because if you want to create that value doesn't happen by accident, right? So if you're going to go in there and you want to force that appreciation, you're going to do the work, right? And the work doesn't come cheap, and you're not going to be able to pull that money out of cash flow to do it. You have to know going in, hey, this is the improvement plan day one, and we're going to have to do that. And the second thing, and I'm sure we can touch on this, on how you're seeing some of this industry changed. 10 years ago, you came into a park and you wanted to make some changes. Most of the times the town wasn't either, the regulations didn't catch up to where things were. So you could go in kind of carte blanche. You can execute your game plan with very little pushback from any county or city official. Now, things have completely changed. Like, we were looking at a park right now, non-conforming, which we bought before. Any of the lots that were there, you can't touch. But on top of it, there was a new ordinance in town that any new home has to have a tree, 3 bushes, 2 parking pads. It applies to the old homes too, which all of a sudden now your CapEx plan is totally different than what you anticipated. And that's just, hey, we're talking to the city, and that's a regulation that came in last year because everybody's buying parks and that. And you have to be aware of that.
Yeah.
And you've seen all of this, because you've got the vantage point of being an owner in the early 2000s, which very few people have seen. And you've gone through all this cycle, and you've seen this evolution. I mean, what have you seen different from 2 points? From the buyer pool, number one, like how different is the buyer today than maybe it was 10 or 15 years ago? But secondarily, like, the selling pool, right? Because it's, back then I'm sure it was all mom and pop, right? And now it's completely different. Like, so where do you see that dynamic changing?
Yeah, it changed a lot. I mean, going to the first thing that you were just talking about. I mean, people neglect a lot of their due diligence, and they just are really looking, especially when it's an acquisition guy running the deal for a fund, or running the deal for like a small syndication, right? And it's other people's money. Okay. This acquisition guy gets big eyes. He sees a paycheck. He's going to tell you what, you need to hear for you to say yes about him buying that park for you. And because he wants his 3%, he wants to get his fee, and he's going to neglect, at least on a couple of these deals, and it happens often, and we use it to our leverage often, as far as big brokers go, because we know what you guys look at. And, they often will neglect the infrastructure, the municipality, like including the zoning, the non-conforming, like what happens if you replace this home to the setbacks to all the other homes and to the rest of the park. And like, boy, like you gotta train your team. Whereas before, you didn't have any of this stuff. You had me and you. We made a deal. I went and talked to the city and said, hey, is there any issue with this park that I need to know about? They say, no, we hate trailer parks. Just, like, get the crackheads out of there, and, we'll be happy with you, right? And you bring them some biscuits or something, some flowers, and like, it worked well. Now it's like a whole team of guys coming from, New York, Chicago, Miami, LA. And, you're going into these kind of towns. They're like, wait a second, you guys are going to, jam the rents, and you guys are going to do this stuff, and you're going to leave us probably worse than we were. And you know what? We're going to put all these rules in place, and we're going to start enforcing these rules. Then with a park in Florida right now, guys owned it for a few years. We're literally about to go under contract with it. He gets told by the city that the culvert outside of his property line that leads to his property is now his responsibility to place, because his property benefits from it. It's like a $60,000 culvert to replace. It's like, what the heck, guys? Like these people don't tell you these things unless if you literally start digging into them. And so you have to go as a buyer, do that. Now, going to your second point, like who you're dealing with now, and like how it's kind of just different now. It's a whole different animal. When it was just me and you, and we were just trying to make a deal happen, it was fine, And now today's it's not. Like, the chances of you using a broker and getting the seller and the buyer, like the actual decision makers, on the phone with each other to hash out any disagreements or any misunderstandings, or to, get in line with each other to understand what needs to actually be done in this park, it's rare nowadays. It's not a kind of thing. As a buyer, now when you're finding your deals direct, you might have an easier time getting past and like to the actual decision maker on the seller side. But when the broker's involved or when there's a team on each side involved, you got this mess of organization that you're trying to work through. And then, you have to understand that like you're gonna miss some things on that. And it becomes, becomes sometimes detrimental,
Yeah, and solely though on that, like I've started seeing, I'd love to get your vantage point on it. It's not so much that I would predominantly buy from mom and pop. Like that was my
gone
avatar, right? And now
Yeah.
it's you've kind of gone through a cycle, whether it's an operator or a syndicator that maybe realized they bit off more than they could chew, or thought they could dip their toe into the mobile home park space, not realizing how encompassing it is, right? Like, see how you're solely focused. Like there's a lot of different verticals that you need to be involved in this space. And so the seller is a little bit different. We've had to change that avatar a little bit.
So there's like, I don't know, 55,000 parks in this country, right? Plus or minus, depends which database you're looking at. Some say 48, some say 62. It just kind of depends, the parceling says it 2 parks when 2 parcels are next to each other, who knows, right? But let's just call it 50,000 parks plus or minus. And in that 50,000, the vast majority of them are going to be under 50 units, right? And even of those, the vast majority of them are going to be under 30 units, right? And so when you look at it from an investment standpoint, the mom and pop that used to own the bulk of the stuff that was like 50 to 200 lots, okay, like they probably own less than 10% of those parks today, okay? And because the syndications, the equity guys have come in and they've done, they bought them out, as what happens with any asset class as it starts to mature. Now all that's left with the mom and pops are these smaller parks. And now we're starting to see consolidation in there. And that's like, there's a guy in North Carolina who's a good buddy of mine. I mean, he's been on a tear. He's been buying these things up. He's at 2,500 lots for, predominantly 30 space parks. And he's doing a great job with them, but he's buying most of them direct from mom and pops or through brokers, a good bit of them. But, the mom and pop game at the level that it used to be for the bigger stuff is gone. So you're going to have a hard time now finding anything like that. I think we ran a report, I think it was the beginning of this year for the data, for the data sets that we had of like the number of mom and pops that still own a 200 space park in all of America. That it was like an atrocious number. It was like, I don't know, it was like less than maybe a few hundred, maybe 500. I have to go back to that number. And the majority of those were very tertiary, and they were like, areas that you're just not going to want to invest in anyways, even though the size of the park's there. And so what we've seen is this equity group, whatever you want to call them nowadays, syndicators, fundraisers, like just an equity group that comes in that maybe came from multifamily or just heard about all the money you can make in this industry. And they've gone around buying things. And to your point, sometimes they bite off more than they can chew. And then they call their other friends, because it's a very small world in our thing, and say, hey, I got this, 150 space deal. You should buy it for me and, get me out or JV with me on this. And, we can partner in and, limit some of the risk on this thing. And that's what's happening today more than I've ever seen in my career, right? It's like the swap out between groups without, it's no longer a mom and pop to an equity group. It's now an equity group to an equity group. And maybe a broker's involved. And oftentimes they're not involved because it's such a small industry. It doesn't take very long to learn all of the top 100 guys in our industry that are buying these things. Now, the top guys, the ELSs, the Suns, the Coves, the things like that are out there, their buy box is so small, and they certainly don't need a broker to help them sell. They only, they're happy to pay a broker to help them buy, but trying to find the stuff that they're buying is blonde hair in a haystack kind of thing. And the equity groups, we're going to start seeing that, I think, in my opinion, be, really a trade amongst themselves kind of thing as this industry continues to evolve. And now that we're dealing with the only mom and pops that are left on any significant level in this sub 50 unit category, I don't know what this means for our industry as we, go through the next 10 years, but I imagine it ends up being a lot like multifamily, where it's, going to be more of a, the matured asset class that, has got very predictive kind of metrics that are going in place. And,
so we have this internal debate consistently, and it's, in the case for small parks, which you talked about, one of your friends that's purchasing these 30 unit parks, these 25, 30, and you could find them. Like, the interesting thing is you could find them at great values, right? They're still, they'll trade at great cap rates right now, like entryway, where, the model was 10 years ago, even in a distressed park, I could walk in and it's a 10 cap walking in and there's this cash flow and it's predictable. And now to get that return on those bigger parks, you have to dig in deeper. You have to be willing to do some work. You might have to be willing to do some infill. Like, to your point earlier, there's some bandwidth and brain damage that you have to take on in some of those larger parks to make that, if you're looking at that value and that 20% IRR, right? You have to be willing to do that. However, in those smaller parks, you could still find some of that initial cash flow value. But the challenge, like the conversation we constantly have, it's, how is the management going to run, right? Because our expenses, if you're going to run if we're going to manage it the same way, right? You professionally, you want to run it on the same platform, right? There's a cost involved to do that. And to do that, it's tough to mitigate that cost out, because some of those costs are going to be fixed on 30 units, right? It's the same cost to do it 30 units as it is 100, but it costs less at 100. Like, how are you seeing it that they're effectively managing that 30? Are they pulling back services? Like, what are they doing?
No, they're actually improving the services. Like, his model is really good. And it's like, I think we're going to see more guys like this pop up in all the major kind of markets that are out there, because this is a model that he's doing that's really proving itself. Now, he hasn't gone full cycle yet, so hold your breath, right? But from a operational standpoint, the clustering works very well. You're buying from a mom and pop. You're often going to be getting some good terms, or some, seller seconds or something like that from there. You're buying at, typically, not typically going to be at 5 and 6 caps unless you're in like major markets for these, like you're in Charlotte, or if you're in, Atlanta. Yeah, you're probably still, even on these small parks, getting a pretty low cap rate, but chances are you have a lot of upside in rents, because mom and pops historically haven't really pushed the market too much, right? So what you're doing, but most of the time you're probably getting in that 7 to 9 kind of cap rate kind of range, right? Now, granted, whose cap rate, I don't even want to get into that discussion. Is it the sellers? Is it the buyers? Is it mine? Who knows, right? But like, from a, call it an entry point cap rate for the purchaser. But now what you can do is start clustering, and like, if there's a park, it's like maybe 15 units. Okay, it's going to be hard to ever manage. I mean, end of story, right? But if you go and then buy 5 or 6 other 10 to 30 unit parks within a 5 square mile kind of thing of this park, and not like a city mile, but like a country mile where it's just nice and 5 minutes down the road kind of thing. Now, all of a sudden, you could have that 100 unit bandwidth for the one manager to go and deal with, and the one maintenance team to go deal with. And that's what this guy has done very well. And so as your cluster builds, you can then, expand that radius a little bit further. And as long as you stay in the kind of the market base of that location, you just pick, whatever secondary, it's usually not a primary market where you're going to see some of this. I mean, I guess we're seeing it actually there too, but like where he started was not tertiary and it was not primary. It's mostly like secondary markets. Like if you think of Atlanta, think of Cartersville, except don't think of Cartersville. But if you're thinking of like markets like that, like that's like that kind of distance from the city.
Correct.
And it makes it easier because you can still draw from a good population base. You're still getting sort of, inherent, property value increases, things like that. And now you're having a manager that, you just, put them on a per lot type of management fee, or on a percentage of the total revenue fees. And he's able to now, reallocate his time to the 8 parks that make up the 150 lots or whatever it might be. And then you build out from there. So like, that's how you mitigate the management risk, because that's probably the hardest thing for people to do, is the management and the maintenance kind of aspect of dealing with small parks. But there's still other costs that you just, like you buy 10 parks that are all 20 spaces, you got the taxes there. Well, it's going to still be more expensive on taxes than it would be 200 space park. End of story. That's the per dollar per unit cost. Same with insurance, but eventually you get big enough, you can do some umbrella and you can get things a bit more comprehensive. But scale is what becomes critical in that environment. Now, when we go full cycle with this stuff, if this guy ever goes full cycle, he seems to be indicating he's more of a permanent holder. But if he ever goes full cycle, selling these off now in tranches might not really be so hard to do. I mean, we do it all the time as brokers here. We'll build a 5 to 10 space kind of cluster, from a couple owners in an area and sell that, to the next guy and used to get good premiums for it. Today, it's almost better to sell them one-offs right now, but it just kind of depends, I guess. But
so I was going to ask you that. Do you think that there's because the idea or the goal is, if you speak to different operators, syndicators, is all right, if I aggregate, then there's a premium, there'll be a yield premium on
used
the
to
sale.
be a guarantee. Used to be a guarantee,
And it used to be, and that's what people would look at. Now you're, on that smaller park, all those smaller communities, the challenge was there wouldn't be a premium. Each one would be kind of looked at individually, but you're seeing where the market's going. You think that there'll be a premium on that exit, whether it's on a refinance or recapitalization or sale.
Correctly, I think you'll still get something for your efforts for consolidating it. Are you going to get that, 1 to 2 bip, 100 to 200 bip kind of compression that we were seeing in 20 and 21? Probably not, but probably still getting a quarter point, half a point, something like that. Like the issue is you just can't spread it out. You can't go and buy 3 little parks in this MSA and 3 little parks in that MSA and try and sell it as a portfolio, because there's no scale there,
Correct.
And that's going to be impossible. And if you only have 3 little parks, I'm not getting you any compression there. Okay. You need to get to that, threshold, whatever that number is. Like right now we're doing a deal for a great guy. He's a great operator. We've known him for about as long as I've known you. We've helped him come up. We're selling his package in Fayetteville right now, Fayetteville, North Carolina. It's 21 or 22 parks. It's an insane amount of parks, right? It's only 700, 800 lots or something like that, But he built it well enough that the tranches that we're doing this in, they're all within like a 3 to 5 mile radius. I mean, many of these parks are just literally next door to each other, right?
Sure.
But still, in today's market, we're not getting him the 4, 5, 6 cap type stuff that we would have gotten a few years ago. The debt doesn't support it. The buyer attitude isn't there for it anymore. But is he still getting better than selling those things one-offs? In my opinion, yes. And will a buyer that's buying something like that still appreciate having that kind of scale? In my opinion, yes. There's another portfolio I've been, selling for, for over a year now. It's like a perfect portfolio for somebody. It's, 100 space average, park, it's got, 30 something parks in this deal, but they're spread out over like 8, non-touching states. And it's like, a little hard for a buyer to say, well, how am I going to make this work at that level for that condensed, compressed cap rate that you guys are looking for? And they're not wrong. So we've now been slicing and dicing this thing up, and now this thing's selling. And actually on the singles, we're getting premiums more than we were getting, evaluated on the on the whole package, which I think it's because the buyer pool right now doesn't have the depth that it used to have. When we were getting like that free easy money at 3 and 4%, the buyer pool was massive. People were taking the risks. Whereas today, we're all parking around 5-6% cap rates, with the or interest rates depending on the kind of park, or 6 or 7s depending on the kind of park. And so you're having to model that in differently. Whereas the one-off cherry pick is getting a better price than the consolidation of 500 lots that maybe aren't as great as a package versus that 100 space park that is like a cherry with the, what we used to call the dog and pony show. You have one pony and 4 dogs. It used to not matter that much. Now it really does matter. You better retail those things out, sell them one-offs, or sell them, 2 or 3 at a time that are very, clustered together. Then you can start at least getting a decent basis on there for the seller.
Yeah, because if you come into this space as an investor and you want to own a park, you have to be willing to be an operator. And I think one of the huge differences between multifamily, if you were to spot and I buy 5 multifamily apartment complexes in different markets, you could probably sell that as a package, because as an asset manager, as someone buying that package and wants to manage that asset, I could probably find 5 property managers, if the market's decent, that could do a well enough job.
Correct.
But in this particular sector, you have to be able or willing to say, I'm going to operate this myself, because there is not a plethora of third-party managers in some of these markets that you could rely on. And so when you own a mobile home park, right, you have to be, you don't just own the park, you've got to own a property management business, you got to be a retailer, right? You have to have that component, because if you can't add that in, your operations are going to suffer. So you have to look at this from and so your point on clustering and the value of that is so critical. Like we're in different markets, but in the markets we're in, we go deep in, and we'll own multiple assets inside that market, because that's the only way to do it. And that brings the economy of scale and allows us to bring down costs. Yeah. And we might be in 4 states, but we're concentrated in the areas of the 4 states where we're at. And we think that that's a huge, huge value for that.
Yeah. We have another guy that we're helping right now. He has 8 or 9 parks in 7 different states, 9 parks in 7 states, and he's like, so like a portfolio, right? And these are not states that touch, like they're all over the place. It's like, took us a while to explain to them, like, no, we're going to have to one-off all of these things, and so like we're closing this first park of that cluster here in North Carolina in a couple of days, and he's getting a cherry for sure for it, and we got stuff in Illinois, we got stuff in Michigan, we got stuff in Arkansas. It's like, it's all going to be hard one-offs to get things done, and so like buyers that came in with the pretense in 2017 to 2020, hey, whatever you have, it's going to sell like gold. It's going to be perfect. That model's changed. And, like, I hope you set your investors' expectations correctly, because that model has changed. And we're, right now, the best bang for the buck is the one-off if you're not clustered well.
So where do you see, and you obviously speak to you get your finger on the pulse of the market, right? So what do you think is the big differentiator between a good operator and somebody who's just not? Like, is it what, from your vantage point, from having spoken to thousands of people on both sides of the table, like where do you see the differentiator, and what's the key components that if you're going to operate, or you're going to look to be an operator here, this is the things that you need to have in place?
Guys with a good team, man, the guys that aren't cheap, and the guys that can take an expensive project, like redoing your sewer lines, redoing whatever, and finding a way to do it more cost effectively without skimping on the quality of doing it. Like that's the hardest nut to crack, is figuring out how to do those kind of projects without breaking the bank, and still having to do it even if it's going to break the bank, because like the operators that I respect the most are the guys that are willing, like to spend the money to improve the park, not just raise the rents and then take, some of that cash flow out to go and like pave a parking lot or something like that, or to pave, the driveway, or to replace some skirting. But the guys that go into a park and say, you know what, this needs to happen. We need to get rid of the metal on metal, like the metal skirts and the metal walls and the metal roofs. And we need to go put, shingles on and PVC on the walls. And like, we need to improve this thing, and we need to fix the roads. And they've set their investors' expectations correctly during the acquisition, that, hey, we're raising this extra amount of money that's strictly for this CapEx, before we go in and raise the rents, 25% in order to do it. Now, it's okay to go recoup your costs afterwards from the tenants after improving their lives and doing what you got to do, because a lot of these parks are falling into just a terrible state of disarray. And, we don't want them to stop being the highest and best use. So you have to, put the money into these parks, and it's okay to get paid back on that stuff. But the guys that have figured out a way to do it, like there's this one group that I had just massive amounts of respect for. They figured out a way to bring in cheaper labor from Mexico through their visa program or whatever, and they're getting the same $100,000 job done for like 50 grand, and they're able to bring it in that way. They're bringing in engineers and things like that are like high quality workers that the America people that gave them a quote are like 2x, 3x over what they're able to do this in-house. Now, granted, they got almost 10,000 lots or something like that, so it makes sense with how they're doing it. It's 7,000 lots or something, and then other groups that use a similar kind of thing where they've, found a cheaper way to do the same project, and they don't hesitate to do it, even if the park's not cash flowing yet, because it has to get done. And it's like kind of in that mentality of like, this is going to be costly, but because we have the scale, and because we know there's a future here, and we know that the city's going to appreciate it if we do it, that this has to get done. And so they go and either raise a second fund from their investors and pay a 10% IO on it or something like that. Or, they go and find some, good, cheap labor from out of the country, bring them in, house them for 90 days, get the project done. That kind of stuff, like, I think it's cool. I think it's pretty interesting to see that kind of play, because like the other guys that just like, we see them all too often, they come in, they under budget what they think the CapEx is going to be. They go and close on the park. They then say, "Oh, sorry, investors, we need to do a capital call. Sorry, tenants, we're going to raise your rents like an obnoxious amount of money." And then say, actually, we're going to put this project on hold for 6 months before we actually start, doing the project. And then instead of the 4-inch topper on the road and fixing all the pavers, fixing all the potholes, we're going to do sort of just some striping and some, 2-inch kind of topper. And, we'll get back to it in a couple of years once it's, like that's the kind of stuff I see all too often, that I'm just like, I go, why, guys? Why? Like you're not doing anybody any favors here, There's a great group out of Ohio. I just closed a nice, 150 space park with, and they've done a real good job on their extremely heavy value add projects that they've gone in, but they are meticulous in underwriting what their CapEx is, and before they've done any rent raises, they're going in and starting like day one doing the improvements, throwing in that extra 5% of cost of improvements out the gate. And, telling the tenants, like they're following the right game plan. Like, hey, guys, like we're going to put this in. We're going to bring you back up to speed because your park is disgusting. And, it's going to come at a cost at some point, but let's get it done for you first. And we're not going to overnight you up to market. We're going to put you on, on a scale, and it's okay. And it's going to, make sense, and everybody's going to be happy at the end of the day. And these guys have done two of the hardest deals that I've sold in a while. These guys bought, and they were in Ohio and not great markets in Ohio, and have done so far a bang up job.
That actually brings it to the next question, because for a long time, the Southeast was the place everybody was pivoting into. A lot of capital was pouring in. You've got a great vantage point because you're doing deals across the country, you and your team. Where do you see capital flowing? Are investors looking at different areas? Are there different markets now that have become hot spots, where we shouldn't be sleeping on, or we should be paying attention to? I mean, everybody knows the Texas story. Is that still the case? I mean, where are you seeing capital flowing, investors looking at? Where can you find value and cash flow? Where would be your
yeah, it's funny. It's funny how that works, like we've done deals, I think, in 42 states now. And it's the South, in my opinion, still hands down the best place to put your money. Okay. Like from a time value headache, from a population growth, from a home value growth, from the cost of labor, from like the rent growth that we see here. And, our rent growth, like it just keeps going, like $1,000 lot rents in so many markets right now. It's insane, whereas like you get west of Colorado, west of the Rockies, I fall off a cliff out there. And, like if I do 1 or 2 deals out that way, I guess I do more than 1 or 2 deals out that way every year, but like, I'm not focused on there. But like California, I just don't understand any of California. Okay. Like I don't get it, Portland or Oregon, again, I don't get it, like, so the Northwest, Oregon, Washington, Montana, like I totally get it out there. There's just so few deals that trade out that way. But we do 1 or 2 every now and then out that way. In the Southwest, it's a beautiful market. Makes sense. They got good, very similar type of metrics that we have here in the Southeast with population growth and home values and rent growth, et cetera, et cetera. But Texas is a weird anomaly, like Texas, the same park that I would sell here in, Gastonia, North Carolina or something like that, I could sell for a 5 cap. In Texas, that thing's a 9 cap. That part I don't understand, Texas, unless you're in like Houston or one of the major markets, that world out there is the buyers are stubborn. They don't pay aggressive rates, it seems like. So from a buyer's standpoint, it's a good market to go buy in because you'll probably get a better cap rate out there. And it's a very favorable mobile home market. We're doing an RV park out there right now. Again, it's like a market. There's not really where I play too often, but the mechanics out there make sense to me. Like I get it. It's like blood red and it's, very favorable. And, you have good population growth, rent growth, all the metrics that I just mentioned. And it's an interesting model. But the Southeast, in my opinion, still has the best of it all. The Northeast, hey, it's beautiful up there, but it's a little knuckleheady up there, like it can be a little hard for an owner to do what he's got to do with tenants not getting in your way. Pennsylvania is getting a little scary, if not already is scary. New York, boy, they bottomed out for a minute. And now New York, to me, actually looks like a great place to go invest in if you don't mind the tenant kind of concept, because there's just no buyers in New York right now. So you can go pick up things at high cap rates in New York right now. And if you buy the right kind of stuff at the right kind of rates, you're going to probably do all right. And, but accept the fact that you're never going to push your rents ever again in New York, ever again. You're going to get,
and that's what drove me out of New York. It's the craziness of I can mitigate a lot of issues. I cannot mitigate political issues that I have zero control over. And you can have the best case in the world and go to court on, with the tenant, and the judge just has a feel right for this. And even though they know that you're right, they just want to, and it was having that issue happen enough times in the city where you're like, well, this doesn't make sense. I know how it should be, and it's not working. I needed clarity. And that's why I'm in the Southeast.
Yeah.
And I agree with you. I think the populations there are still growing. I think there's a lot of markets there where there's a viability in the economy where you could see if you create value, you'll get value. There's, and I think it's a good place to do business and call home. We had looked in other markets, whether it's Indiana, Ohio, the challenge is, Glenn, I'll say this every time we're like, all right, let's go start really taking a look at it. We start looking at deals. All of a sudden it gets to wintertime and like, wow, if I go there now, I need to bring a winter jacket. And I just think, I'll wait. And then maybe I should get out of that.
It's odd because you got New York, which everybody's just got this like weird kind of like anti thing now because it's liberal and blue and tenants and blah, 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 blah. But you could buy a nice deal. There's a real good buddy of mine up there. He owns a ton of parks up there and he does extremely well. And he's buying at 9 to 12 caps on a day-to-day kind of basis, and they're stabilized type stuff. He just throws a little bit of money in to improve them. He gets a little bit of an increase for the CapEx that he's put in there and does very, very well. And it's nice looking stuff, and he's not competing with too many people to buy anything, and that's nice.
But I bet you because of that regulation, he probably has the right system, because that, if you don't have the right paperwork and you have to file your DHCRs, which is Department of Housing Community Resources in New York State, if anybody invests there, if you don't file that and you don't follow that and follow your improvements, you can be, it could be very painful and very costly.
100%.
And
He's
if we're
been
talking
with
about
long
the same
enough. He's
guy,
figured this out. There's
yeah,
two guys up there that I'm good friends with. They both
yeah,
have their own investments up there, and they both do very well. Except, when they think about selling something, they're like they want some cockamamie kind of pricing. That's like going to be hard to sell to somebody else, because it's
sure,
still at the end of the day New York. But then
yes,
you go over into like New Hampshire, and people there that have very hard regulations in New Hampshire, very strong tenant rights in New Hampshire, they're getting crazy, crazy cap rates up there. We did a park up there towards the end of last year. It was like a 5.25 cap or something like that, and that wasn't even that big of a park. It was two parks, and like we sold them separately. One to the tenants, and they paid a nice penny, for their park, and then one to an investor, and he paid a great number for it from a seller standpoint. And there's not much difference there. You had to do the tenant notification. You have the semi-rent control kind of concepts that are there. You have, very liberal kind of environment, and but for some reason the mentality was different there. And it was like a great little MSA that's growing leaps and bounds, and beautiful little parks. So you have this kind of stuff, and then you come over to places like Ohio, which is totally friendly, totally awesome place to be investing in, except they hammer you on taxes in Ohio, right? Or you come down to South Carolina, totally awesome place to be investing in, but absolutely will sledgehammer you to death with taxes down there, right? So you have to really learn how to like mitigate, what these kind of offset risks are. That okay, so fine, you're giving up the liberal for the blood red, but now the blood red is going to hammer you on taxes, right? But you're not dealing so much with tenant rights. So like you have to kind of choose your battle of like where is it important to you. And so I remove that whole kind of thing from how I look at what I'm doing. I look at population growth, medium home value in that zip code I want to invest in, rent growth as I see it as compared to apartment rents, not compared to other trailer parks or mobile home parks or land use communities in the area. So those three things to me, I can deal with the regulation side as long as I'm aware of what the regulations are. But for me, location is still the number one rule. And when I look at buying something, I'm looking at the headache first and foremost, the location. Is it a management that I can keep around, or am I going to have to go and like figure out management? Because that will kill a deal for me if I'm buying something. And then the infrastructure, again, is it turnkey, or am I going to have to go put $1 million into this thing? Past those four things, I could probably make it work. I could probably make the deal work. I don't care if it's New York City. I don't care if it's Chicago. I don't care if it's, Charlotte, or take me down to Houston. Those things need to be in place for me to get comfortable with it. Not so much, oh, no, we're worried it's going to go rent control. Well, if you're worried about going rent control, get your markets to rent and get them to rent overnight, before that rent control comes into place, and do what you got to do. But even North Carolina, hey, we might be in rent control in the next few years. If you fast forward 10 years from now, we've gone from blood red to kind of shiny purple. And, like every 2 years they put it on the ballot, something about some kind of rent control nonsense that gets thrown out. But sooner or later, that they've been knocking that door long enough, you never know. You never know.
But that's why you have to have your operations in check first.
100%.
Glenn, last question, right? Last question. I know, the big headline news has been Brookfield looking to buy Yes Communities for $10 billion, right? Which would set a great new price, a high new price point and level of entry for anybody in the space. Your prediction next 12 months in the mobile home park space?
I think we're finally, you look at the cycles, right? 2012, let's start there. 2012, what a nightmare, right? 2010 to 2012, what a nightmare. Everybody bottomed out. It was impossible to do anything. 2015, we finally pick ourselves back up. 2015 to 2018, we start going up the hockey stick curve, right? 2018 to 21, we're just booming, right? 21, 22, oh, we stagnated. 22, 23, 24, bottom, right? So in my opinion, 23 was half the transaction volume of 22. 24 was half the transaction volume of 23. 25, we're finally stabilized. We're finally doing the same amount as we did now, actually a little bit up over 24. So I think we're finally coming out of that hockey stick again, and we're going back up the curve. So, in my opinion, and I hope it stays this way, and hopefully the debt markets, start looking more favorable, and regulation as far as depreciation and all the things that like kind of give us those extra little incentives start staying favorable. I think we're hopefully hitting this next cycle. I think every cycle's got the expansion in the bottom. I'm hoping we're back into the expansion at the start of the expansion now. I think we're probably went through our 10-year run with the last 2 years being at the bottom. And hopefully that means we're hitting back to that 2014, 2015 type of levels now that we're going to start going back up on. Time will tell, and my gut's wrong half the time, so I don't trust it so much anymore. But, seems like the predictors are in place.
I think if anybody has a pulse on the market, you do. And I happen to agree with your notion. I think we are starting to see that curve start to change. But this has been great, Glenn. If anybody needs to reach you or reach out to you, what's the best way that they can contact you if they have questions, if they want to sell their park, if they're looking to buy a park? How would they find Glenn Esterson? Which
super easy. You can just go on LinkedIn, type in my name, Glenn Esterson. I'm the only Glenn Esterson as far as I know on this planet, so very easy to find me there. You can Google me. Our team's website for brokerage is EstersonMHCteam.com. You can go to our expert website, which is the MHPExpert.com. And my cell phone number, 423-483-0492. Call me. My phone rings all day, so I always get back to people. I always return calls, and, we'll see what we can do to help you.
That's great, man. Glenn, thank you so much for being part of this episode. And before you go, I want to ask you out there listening one simple question. Would you help someone you didn't know, someone who wants to learn about real estate investing, somebody who wants to learn how to find, fund, or operate a mobile home park? And if the answer is yes, then give this episode a rating, drop a comment below on your streaming app, and then share it with us at the MHPExchange.com. If you do, I'll send you a copy of the after site visit report that we use, the same document and format that we use with our team to ensure accountability and make sure that our asset plan is moving forward to create value. Till next time, everyone, this is Frank Rizzo with the MHP Exchange. Happy investing.
Thanks, Frank.